Hello and welcome to the Technical Day Trader. Today we're going to be looking at moving averages, which are the fundamentals of a lot of technical indicators, as well as people who do strictly technical analysis have an understanding of moving averages, as well as people who are more fundamentally biased. Almost everybody uses moving averages as a way to kind of smooth price data, which can be erratic, and as well as define trend direction, crossovers, and they can even be used in support and resistance. So first what I'm going to do is we are going to look at a 20-day simple moving average, as well as the 20-day exponential moving average, and we'll get into those in a little bit. And we're also going to look at two other very popular, more macro, a little more lethargic moving averages, and that's the 50-day moving average as well as the 200-day moving average. Alright, so first we're going to look at is the 20-day simple moving average. So what I'm going to do is go to Add Study, Moving Averages, right here, Simple Moving Average. Now, the default in my Thinkorswim application is a 9-day look back period, so what I'm going to do is go in and just change that to 20. Also make this line a little easier to see. And blue's a good color. Okay, so here we go. Here's a 20-day simple moving average, and as you can see, it does exactly what it's supposed to do. What it does is it takes the last 20 days and it finds an average price for that look back period. Sorry. And it just creates a line. So as you can see, in scenarios like this, you get a big up move and then a big down move. Well, what did the moving average do? It made a little bubble, but then basically continued on its upward path. And also the 20-day simple moving average, and I'm gonna quick zoom in right here. All right, and this is Under Armour. So Under Armour, a little biased. It's been in a pretty well-defined bullish uptrend ever since 2008. Everything took a hit there, but ever since then, it's been a pretty bullishly biased stock. It has a lot of growth potential. So what we're looking at here is the ability of the 20-day simple moving average to provide support in that scenario in a bullish uptrend. And as you can see, once buyers have it closing above that average, that makes it an area of support. And as you can see, even on this gap down day, buyers bought it up back to that 20-day simple moving average again, bought it on the next day, and then you get enough buying pressure to get it back above that line. It closed above that 20-day. Again, right here, you have a big sell-off day. Bulls right back in. The buying pressure, you get a close above that line, one more test on it, and then you get a gap up, and that's basically off to the races after that. You get a little sell-off here, provided support, bulls came in, gapped up, and then you're off to the races again. Quick sell-off, boom, buyers are there waiting for it. And that's just an example of the moving average being able to provide support. The other scenario is, let's say sellers are dominant. Okay, so it closes below the 20-day moving average in let's say a downtrend. It's going to use that as resistance where it's going to sell off. Buyers will come in, and when it gets there, there's not enough buyers to get a close above that, or if the line is trending downward, it usually uses it as resistance where sellers are going to come in once it gets either touches or gets close to that line again. Alright, I'm going to back out real quick so you get a better view, and I'm going to apply a exponential moving average. And exponential moving averages basically use a multiplier to stay a little closer to price data. Therefore, the 20-day simple moving average is going to be a little more lethargic in its reactions to prices than the exponential. So I'm just going to get in here real quick. Again, the default's 9. I'm going to edit it up. So we want a 20-day look back period for our exponential moving average, and make it a little bit easier for everyone to see. Let's make it red. Okay, so in this scenario, and I'm just going to quick zoom in right here, you can see that in this little period of consolidation where it's just basically trading sideways. There's no real defining trend. You get a few crossovers of the exponential, and as you can see, that red line stays closer to price data. A lot of people use these crossovers as indications of being able to get in, not necessarily on a 20-day, because in periods where it's going sideways, they call that a consolidation. It can whipsaw you. You can be in and out and in and out and in and out. You want to use these more for defining long-standing trends. So in this scenario, we're just taking a look and understanding it. Here's a crossover right here with a gap down, and once you get below that 20-day, as we spoke about earlier, all of a sudden it's the sellers come in strong, finally find support at a recent low, and then the buyers buy it back up, and you get that close above. Now it's going to be used as support again. Now this little pop was a killed earnings for them, but as you can see, they kind of have a gravity to them to a certain degree. Even when news just kills it and the company's doing fantastic growth out the wazoo. Still, if it gets too far away from the moving average, usually it kind of has a gravitational pull back down, and then buyers are going to come back in the scenario of a bullish trend. Okay, next we are actually let me just reset this a little bit. Next, we're going to look at the 50-day moving average, which is a little more lethargic. Great for support and resistance levels. The larger the period of the look back, usually the support and resistance is even that much more strong in terms of being able to get in after a sell-off, or if it's selling off in a downtrend, you use it to be able to get in short. So I'm going to do simple moving average. Okay, I'm going to grab it again. I'm just going to edit it in my application. We're going to put in 50 days. And make it easier to see here, make it green. Okay, cool. And as you can see, it's since it takes in so much past price data, it takes a while for this thing. Even though this stock is just booming right now, and we looked at this area when we were talking of support, it takes a while for that to come off those lows and start moving up in the uptrend. But once it's moving up, it takes a long period for it to be able to move down. So here's actually perfect. Here's a little scenario where, okay, it's basically trading sideways after that real bullish run, and it comes in, and right here on this sell-off day, you get a little support bounced off of it. Second day, again, support, but if there's more sellers than buyers, that price is going to break through there, and once that happens, it's usually a rush of selling, because that's an indication that sellers are just more. There's more sellers than buyers. But again, you can see as that 50-day. It's still in a pretty well-defined uptrend. Kind of gets flat here, but prices, little gravitational pull here. It's since it closed below that line, it's using it as resistance. So you're not seeing a lot of buyers where you can get that price to close above. Where it would turn into support again. Not until a secondary sell-off where buyers come in very strong is it able to break through that line and close above. And as you can see, once it does that, it's off to the races again. You get a little test, 50-day moving average holds that support, boom, buyers are way back in. Again, test. And that can go on for a long time depending on the stock that you're trading. And next we're going to look at the 200-day. Moving averages. There we go. Simple moving average. Again, I'm going to take it and edit it in my Thinkorswim app. 200-day. And we'll make this one yellow. Okay. Now let me back out so you guys can see this. Okay, so as you can see, that's a pristinely defined bullish uptrend. It was tested back in, let's see, what is that? Early 2012, tested the 200-day moving average, kind of bounced around, got a little congested in here, and then off to the races. And you don't even see that 200-day for 6 to 7 months where it's tested again. But the second it's tested, it's in a pretty pristinely defined bullish uptrend. It's off to the races again. Now, what's interesting about especially the 200-day is its gravity. You have a huge rise in prices here. Buying pressure is through the roof. And then it's going to consolidate sideways for quite some time and just kind of trade around until it returns to that 200-day to test that support's still there. Prices don't just go exponentially upward and get, miles and miles away from the 200-day. Most all stocks, that 200-day moving average has that little bit of a gravitational pull, but once it tests it again, off to the races. And again, you see how far away it is from here. It's going to come back down and test it again. Now, this is holding for the time period, and you're getting a little bit of a what you call a flag, where you have support rising, but you also have resistance falling. And once that gets to a real tight trading range, it's going to either break low or it's going to break high. All that energy is released in one fell swoop, and that'll tell you if that bullish trend is going to remain intact, or possibly it could go through a small period of a bearish trend. But I don't predict that stuff. I look at the technicals and make decisions from there. So I hope you really enjoyed the video. We also have a full in-depth article that you can look at our website, and that's it for today. I hope you enjoyed it, and we'll see you guys later.